After a few tough quarters, the Golden Arches seem to be regaining their sheen. That's after McDonald's earnings beat forecasts. First quarter profit rocketed nearly 50% to $1.23 per share. That's compared to 84 cents for the same period last year. The global fast food giant turned things around when it introduced the all-day breakfast menu. I'm a big fan. Sales also got a boost from special food promotions. U.S. sales at stores open at least 13 months also beating expectations. They rose more than 5%. Now that is 2 consecutive quarters of growth. And globally, Mickey D's did even better, same-store sales gaining more than 6%. Well, Ronald McDonald was not the only one with a stellar first quarter. Apparently, the Colonel also had one too. Earnings for the parent unit of KFC, Yum Brands, also beating expectations. They came in at 95 cents per share. Operating profit grew 21%, and most of that came from its booming China business. Global revenue coming in at $2.6 billion, with China accounting for most of it, with a 12% sales growth increase for KFC. Let's get more on Yum Brands' earnings and the fast food market in China with Dan McClory, Managing Director at Bonwick Capital Partners. Dan, always good to see you. Thanks for joining us.
Well, thanks for having me on, Michelle.
So Dan, Yum's China business certainly gaining strength, a 6% increase in same-store sales, just as the company is planning on spinning it off. What's driving this growth?
Well, I think the growth is a comeback from the chicken food scandal that occurred last year. But I think it's also management has found its footing a little bit more with some of the other challenges that they had. And isn't it ironic, Michelle, that on the heels of this spin-out announcement, which most commentators had thought was because of flat growth and prospects sort of leveling off in China, that they now find themselves very much at the forefront of the Yum growth story once again.
Absolutely. Do you think that it may change tact on this position now, keeping in mind that Yum's China business, KFC and Pizza Hut, accounting for about half the company's revenue?
I definitely think so, Michelle. As a matter of fact, I'm looking at this current offer that's just being discussed. The size of the offer, the amount, $7 to $8 billion is what's being rumored from CIC, of course, China's Sovereign Wealth Fund, and KKR. And that's a quarter of the company's current market cap of about $33 billion. So I've got to believe when you in China have half of the revenues that are being driven for Yum, how you're going to settle for a figure like that, it would be hard for me to imagine.
Well, even though it's been a stellar quarter, Yum has been losing market share to McDonald's. McDonald's, as you know, also had some struggles in China, but posting greater than expected growth in China in the past quarter. Why is Yum losing out to McDonald's, and what is McDonald's doing right, Dan?
Well, first of all, you've got to understand, as you know from the time you spent in China, Michelle, KFC is one of the most entrenched brands in China, Western or otherwise. So it had a far, far deeper group of stores, much larger numbers than McDonald's to begin with. So it's not surprising that McDonald's, in somewhat of a catch-up mode, is finally starting to increase the growth pace against KFC. That's one. But number two, as Chinese consumers have said, you know, the tainted chicken scandal that affected KFC was much more visible, and it affected Chinese much more than hamburger. So they can look at hamburger and say, well, that's sort of a somewhat still of a novelty and a nuance as opposed to chicken. So there's great differentiation between the two, and I think it's been easier for consumers in China to get beyond the meat scandal that McDonald's had, more so than it has KFC's chicken scandal.
Well, yeah, that Yum scandal with the food quality and safety issues and that tainted meat, that certainly took a dent. What does this mean about the challenge of getting the supply chain right?
Well, it's imperative, and especially with global brands in any market, emerging, developed, or otherwise, they have to provide a consistency of product. That's what made McDonald's and KFC famous in America. That's what brought them to Europe. That's what brought them to Asia. People can rely and depend upon whether it's basic ingredients, certainly quality levels, packaging. All those things are so important. This is just another example of why you have to get that supply chain absolutely right.
And would you say that the perceptions of these global multinational fast food chains are still the same as they were? Are Chinese consumers still holding them in as high regard, or are local competitors now offering a similar experience and product but at a cheaper price point?
That's a great point, Michelle, and I think it's a little bit of both. On the one hand, you have the modernization of the Chinese consumer. So it's no longer just about price and value. It's increasingly about premium products in many, many categories. So the Chinese consumer is evolving just like all other markets have evolved over time. And I think that's important to keep in mind. There's also major trends such as in-home dining in China is flat to declining. So the trend to go out continues. To your point about the local brands, yes, they are very much eating into market share of Western brands when it comes to value and mass. They have figured it out. They've been able to deliver a better product more price competitively. So it's the progression and the modernization of the Chinese consumer combined with stronger entries in those value and mass segments that are Chinese-born competitors.
All right, Dan, always great to get your insights. Dan McClory, Managing Director at Bonwick Capital Partners.